Well, first of all, thank you so much for having me. It's a pleasure to be with you. On the inflation side right now, I continue to be worried about where we are from an inflation perspective. We've been missing our mandate on the inflation side, our objective of 2% for more than 4.5 years. And I continue to see that we have pressure in inflation, both in the headline, in the core, and particularly where I'm worried about it is I'm seeing it in services. So a number of my colleagues have talked about the impact of tariffs and the fact that some of those pressures may just be a one-time price level movement that we should look through. When I start seeing pressure in the services side, things like insurance that feeds into our super core inflation, that to me says that maybe this isn't just coming from the tariff impacts, and it's something we need to be more attentive to.
Given that backdrop, do you think it's a mistake for the Federal Reserve to be cutting interest rates here?
It's a challenging time for monetary policy. We're being challenged on both sides of our mandate. So in the U.S., we have both an inflation mandate to maintain stable prices, but also maximum employment is the other side of our mandate. And right now, when I balance those two sides of the mandate, it's challenging. We're seeing a labor market that, to me, looks broadly in balance. It looks reasonably healthy. We're right around my estimate of maximum employment, that 4.3%. It's risen a little bit recently, but we've been in that 4 to 4.3% for really the past year. On the inflation side, however, what I see is inflation that's been above target for 4.5 years. My forecast is that we're going to remain above target for probably the next 1 to 2 years and not really getting back down to our objective of 2% until the end of 27 or early 28. And so again, to me, when I balance those two sides of our mandate, I think we really need to maintain a restrictive stance of policy so that we can get inflation back down to our goal.
Beth, let me get into the tariff side a little bit more then, because we keep hearing from retailers that they do think that in this final quarter, we are going to start to see that tariff impact land a little bit more. Economists are saying we could be seeing this as a one-off impact, more transitory. How do you think about the economic ramifications of whether the tariff hit will be transitory in nature and therefore you treat it as such?
So I'm hearing the same thing from the businesses that I talk to in my district. When I'm out traveling around, meeting businesses, understanding how they're experiencing the economy, what I've been hearing most recently is that they've been bearing the cost of these price pressures. They've been trying to absorb as much of it as they can to not have to pass it on to their consumers, the businesses that they're serving. But that's not going to last forever. Many of them expect that they're going to have to start factoring in these prices into the fourth quarter and probably into the first quarter of next year as well. There are a lot of contracts that get renegotiated when you get to the beginning of the year. And so it could be that we see pricing come through. Again, economic theory would tell you that a tariff should be a one-time price level impact. However, what that's really modeled after is something more like a VAT tax or some very clean tariff that's announced once, implemented once, and exists persistently from there. What we've seen in the implementation of these tariffs is that they've been layered in over time. There's negotiation, and we got new tariffs announced even as recently as last week. We're also coming after a period of being above target inflation for 4.5 years. And so to me, it's a little bit more difficult to think that this is really going to be just a one-time impact. And so I'm attentive to whether or not this will really be more persistent in our outlook.
And if I could just follow up on your labour market comments about the labour market being in balance at this stage. We're getting set up for non-farm payrolls later on this week. The view is that, look, we've got some seasonalities with the September number, but we could see a stronger print versus some weaker prints in previous months. What could cause more fragility in the labour market from here, and what are you watching for specifically?
So we've been in this low hiring, low firing environment for the past year and a half. What we're seeing is that businesses worked really hard to acquire the workers they needed post-pandemic, and they feel very good about their labor force. They're loath to let them go. And so, again, if you don't have a job, it's been more difficult to get a job, to find one. But if you have a job, things seem to be going reasonably well. When I'm out with businesses in the district, I don't hear that there are significant plans for reductions. What we've seen mostly that's the sign of softening has been that headline payroll number that's come down. Now, it could be that that's a demand story, but we've also seen a pretty material change in immigration in the U.S. So I think there's a supply side to that story as well. To me, when I look at that, it feels like we're roughly in balance. And again, we don't just look at any one individual number. So I'm coupling that headline payroll number with other signals like the unemployment rate, which again has been low and stable, like the weekly jobless claims number, which again has been very stable, the vacancies to unemployment ratio, which is still right around 1, which is actually a historically high level. If you go back to the pre-pandemic past, it was closer to 0.7 or 0.75. And so when I look at all of those numbers together and I couple that with the stories I'm hearing from the district, it feels to me like we have a labor market that's broadly in balance. And again, I'm focused on inflation, which, again, when I'm out in the district, I'm hearing from individuals that it really is eating into their paychecks. They're trading down. They're not able to buy ground beef. They have to buy hot dogs. They're not able to buy meats. They're buying beans or pasta at the store. And so we have this persistent inflation issue that has really been troubling. And to me, that's why we need to maintain a restrictive stance of policy.
You come to the Fed from Goldman Sachs, a long career in the market, so I'm keen to get your take on valuations here. Fed Chair Powell alluded to elevated valuations just in the last couple of weeks. When you look at the stock market trading at all-time highs here, how would you characterize valuations, and is there a risk here if the Fed continues cutting rates that we could see an overheating in financial markets?
So financial markets are not the real economy, but as you note, I did have a long career in the financial markets, and so it is something that I pay attention to. And I think it's an important signal for businesses that they consider when they're thinking about raising capital and thinking about whether or not they want investments. What I'm reading in the markets right now is a market that's not anticipating any sort of a material drawback. As you point out, valuations do look pretty full. I think there's good optimism about earnings, about corporate profits, how that's going to continue to play out. And it looks to me like markets are expecting that we will continue to see robust demand on the consumer side, and the consumer will continue to hold up reasonably well, which will give us a stronger GDP and keep the economy ticking along the way we want it to.
Let me ask you about the independence of the central bank. No doubt it's a topic for conversation. I know a lot of the international central bankers are concerned about the situation that you face in the US. The lone dot we saw from Stephen Myron and how that reflected Trump's stance on what he wants done with interest rates being much, much lower. And of course, the pressure, legal pressure now on Lisa Cook. How would you describe the job of the Fed in maintaining its independence and the optics, given the pressure it's facing from the White House?
So having an independent central bank allows us to provide a more stable and better series of outcomes for the country, both in terms of low inflation and maximum employment. If we're independent, we're able to be free from short-term political pressures. We can focus solely on the data and ensure that we're delivering good outcomes. Right now, you're seeing some things happen in the U.S. that are pretty normal. Having a president or other administration officials who are talking about their views on monetary policy has happened many times in the past, and we appreciate everyone's viewpoints and want to hear their feedback about where they think the economy needs to be set. Having the president nominate a new governor, have that governor be confirmed by the Senate, that's the process, that's what's supposed to happen. But there are some new things that are happening. Having a governor who's on leave from an administration position hasn't happened before, and having the president try to unseat a governor hasn't happened before. Again, what's important to me is that when we walk into the room, that I'm focused solely on the data, whether that's the hard numbers or the anecdotes from what I'm hearing in my district, and then I'm able to set monetary policy to deliver against our congressionally mandated objectives of stable prices and maximum employment.
Beth, as we get going for the trading week, there is a concern that politics may get in the way of this smooth running of the government, whether there could be a government shutdown. Bank of America analysts saying a shutdown would subtract 0.1 of percentage point from economic growth for every week it lasts. Are you concerned about a government shutdown at this stage?
Certainly a government shutdown would be yet another factor that we'd have to weigh into this challenging time for monetary policy. And as you note, I would expect that it would have some amount of drag on GDP the longer that a shutdown lasts. Historically, when shutdowns have happened, they've only lasted a couple of days, and so the impact on GDP has been minimal. But we'll need to watch to see what those impacts look like long term and how this one plays out.
Let me just pick you up on one thing you said a couple moments ago, that you need to maintain a restrictive stance of policy based on how you see the inflation and labor market pictures evolving. How would you characterize restrictive policy?
Right now, I think we are mildly restrictive. After the most recent move, I've shifted from saying modestly to mildly as we're inching closer and closer towards that neutral stance. I have one of the higher estimates of neutral on the committee, and so to me, we're a short distance from getting to neutral. And when I look at where we are from an economic perspective, I'm not seeing signs of real weakness or a real downturn in front of us. And so I think we need to maintain that restrictive stance of policy. I would only want to go into an accommodative stance if I saw a more material weakening on the horizon, and I'm not seeing that at this point in time.